on board Nitin Rakesh, the CEO at Mphasis, and Manish Dugar, the CFO, joining in right now to talk about how their earnings went by. Gentlemen, great to have you on the show. If we could, just firstly talk about the revenue, which has actually seen a decline and more than anticipated and expected this quarter because of the BFSI weakness. Do you think this is the bottom, and should we expect a recovery from the second quarter onwards?
So I think it's fair to say that I think across the industry, we are seeing some real pressure on discretionary spends as well as cyclical, downturn related issues. So for us, this is a little bit more acute because our percentage of revenue from banking is probably the highest in the industry. The good news, though, is that at the back of our large deal wins in Q1, which we hit a new record by quite a distance, and some of that is giving us conversion as we speak. Second, we've already seen signs of early volume uptick in the mortgage business. Clients have actually asked for capacity expansion in anticipation of volumes going up. And a little bit more unlocking or unclogging of the decision making is visible given the pace of deal wins. We do think that we bottomed in the Q1 numbers. So we expect to see a pickup in sequential growth through the remainder of the financial year 24.
Now, there has been a lot of dichotomy in deal wins versus revenue execution. Your deal wins were very strong this quarter. Explain to us, why is there a dichotomy?
Yeah, I think firstly, the deal wins in the last 4 quarters, the average was in the 320, 330 range. This time, we've actually got double of that in 1 quarter. So the deal wins are up more than 100%, both sequentially and on a YOY basis. So this is a step function change in the deal wins. And hence, that obviously has a bearing on both short-term as well as full-year numbers. Secondly, yes, you're right. The conversion from pipeline to TCV was clogged. Even after you close a deal, conversion to revenue was taking a lot of ramp-up time. And of course, the third element that adds into growth is the leakage of a volume ramp down or existing business. And just in the last 4 quarters, we've seen more than a 50% decline in our mortgage revenue on a quarterly basis. So I think what we are now saying is that we've seen the bottom of our declines in the mortgage business. So that leakage is taken care of. We've also seen the bottoming out of our DXC revenue line because we now have visibility into stability over the next few quarters. That leakage is taken care of. We are seeing unclogging of the decision-making cycle because conversion is picked up quite dramatically. So that's definitely giving us a lot of optimism around the ability to continue to convert deals because the pipeline is still up both year over year and sequentially. And finally, we've also seen green shoots in pickup in activity on the banking side, which is kind of what really drives some very short-term growth opportunities because the portfolio is actually that focused and a lot of our top clients are in that domain. So I think it's fair to summarize that pretty consistent across all parameters. We are starting to feel a lot more confident that we've bottomed out and the base formation that we've done in Q1 will really become a foundation for us to continue to see growth through the remainder of the year.
So if we can shift focus and if you can tell us how Mphasis is working towards lowering the BFSI exposure, tell us more about the efforts taken by the company on this front.
A few months ago, we announced a vertical cohort GTM structure, which combines our account-based model with an industry alignment on the go-to-market side. And the idea was very simply, we have had real success in growing some of our large accounts into really, 100 million plus or 150 million plus accounts. Our hope and our focus is to actually take that same playbook into the next set of accounts that have been acquired in all verticals. So this quarter, substantial number of our TCV deal wins, both as a percentage of TCV as well as a number of large deals, have actually come from outside our top 10 accounts. Second, we talked about also expanding our footprint and our focus in the non-BFS segments, because again, that goes towards broad basing our growth. We've seen fairly strong growth, both in terms of revenue. Sequential revenue has actually grown in TMT by 6%. It's grown in insurance. It's grown in healthcare. And I think we are almost, starting to see recovery in logistics and travel as well. So I think that strategy is working. We are very confident that our efforts in really starting to create growth drivers outside of BFS are now starting to take effect at a pretty rapid scale. Thirdly, we've talked about geo. US banking obviously is the biggest exposure. We've seen a 5x expansion in our pipeline in Canada. We actually have one large deal in Canada that was signed in Q1. That deal is for over $40 million. That actually is 10 times our quarterly run rate, so to speak, in terms of, so the impact of that deal in that region is pretty substantial. And the pipeline in Canada is actually up, as I mentioned, 5x. So I think we have a similar story with pipeline in Europe, even though conversion in Europe has been slower than in Canada.
Right. Manish, talking about margins, your target EBIT margin guidance of 15.25% to 16.25%. What levers do you see of hitting the upper end of the range?
The philosophy of maintaining margin in a narrow band while investing for growth, we had shared our confidence on ensuring that it's not only going to be within the range, but with an northward band. It's a small uptake, but it's at least movement from 15.3 to 15.4, and we feel confident that this will continue in that direction in the coming quarters for the year. This is despite the challenges that we had in revenue and all the macro effects that came into being, including the impact of compensation that was kind of carrying on for some while. As we look forward, the supply environment has become a little eased. We are confident of our ability to now deploy freshers, which is one of the things that we have been working on for a while. And we are also seeing utilization improve as we go forward. So on an overall basis, there continues to be tailwinds to profitability, and as revenue scale starts coming back, it will only aid that acceleration in terms of the northward movement. So as we go forward, not only do we believe we will be able to expand the margin, we will be able to do it despite making investments, which we had kind of slowed down a bit as the environment was not supportive of such investments.
So Nitin, going forward, do you think that the momentum in the deal wins is here to stay and you'll revert to the $300 to $400 million range?
I think two things to note. Firstly, the big bump is obviously driven by large deals, but more importantly, a third of the TCV came out of pure AI deals, which means the opportunity presented by the extreme amount of executive focus on driving efficiency and transformation through use of all forms of AI is actually starting to pick up as well. I just want to make sure that we didn't lose that nuance in the TCV numbers. I think in terms of what's the sustainable growth rate or what's the sustainable closure rate, I think the lead indicator is always pipeline. Pipeline is up more than 20% YOY and 6% sequentially. So I think if the decision-making continues to ease as we've seen early signs of, we do believe that we can continue to see healthy pipeline to TCV conversion through the remainder of the year. Hard to give a number because obviously large deals are by definition lumpy. But I think if we continue the trajectory of focusing on large deals as well as driving growth in our existing relationships through organic smaller deals as well, I think we should continue to see a good trend on the TCV side.
Thank you so much, gentlemen, for joining in and sharing with us the roadmap ahead for Mphasis. Let's pull up